Good morning, everyone. Thank you so much for joining us today. My name is Hajra Talat, and I will be your host for today's webinar on corporate tax preparations, a step by step guide to compliance. So, before we dive into the session, let me provide a brief introduction about our company. ACME Group has formally established itself as a trusted tax and financial solutions provider across the GCC region and Egypt. We are committed to delivering high quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build long term relationships with our clients. Our exceptional team consistently delivers value efficiently, making us the preferred service provider in the region. So, let me introduce you to our esteemed speaker for today's webinar, Ms. Aditi Bhoj. Ms. Aditi Bhoj is a senior tax manager with over 7 years of experience in international taxation. She has been actively assisting and advising multinational clients from various industries on cross border transactions, compliance with complex taxation regulations. Beyond her expertise in international taxation, she is also qualified taxation lawyer with postgraduate degree in finance. Her skills in client management and her niche experience in taxation, litigation, and assessments make her a valuable asset to our team. So, before I start, I would encourage everyone in the audience to share your questions in the Q&A section rather than raising your hands, as this will help create an interactive session and ensure that you gain maximum value from today's webinar. Your participation is very important and essential to make this event a successful event. So now I would like to hand over the stage to Ms. Aditi Bhoj to begin the webinar. Over to you, Aditi.
Good morning, everybody, and thank you so much, Hajra, for the wonderful introduction. So, hello, everybody. I'm Aditi, and before we get into today's session, let's spend a moment here and discuss what all topics we will be covering in today's discussion. So, today, my friends, we'll be talking about how has the timeline for the concept of corporate tax filing evolved in UAE. We'll be talking about who is required to file the corporate tax return. We'll also discuss regarding the deadlines which are applicable on different taxpayers. Moving forward from there, we'll talk about whether a company which is claiming small business relief, when do they have to file the corporate tax return? What are the compliances for them? What are the corporate tax filing compliances for qualifying free zone persons? What happens when we talk about the concept of transfer pricing? How is it related and why is it important to the corporate tax return filing concept? Moving forward from there, we'll discuss the rising issues and concerns in the arena of corporate tax and what issues are having an impact on the concept of corporate tax filing in UAE. We can move to the next slide, please. All right, so now let's just dive into the presentation. So, my friends, as we can see, the first topic we'll cover today is how has the concept of corporate tax filing evolved in UAE? Now, do we know and do we think that the concept of corporate tax got incepted in 2023, but it did not have any roots in UAE before that? The answer is no. So, my friends, the concept of corporate tax was first announced by the Ministry of Finance in the year 2022. In the same year, they even published regarding the concept of corporate tax in the official gazette. And moving forward from 2022, as you can see on the timeline on your screens, in the month of June 2023, on the 1st of June 2023, the corporate tax law got effective in UAE. Now, my friends, what happened? After the corporate tax law got incepted as well as effective in UAE, after that, all the taxpayers were number one, required to register themselves for corporate tax. There were several requirements for registration, there were several deadlines for registrations, and the first tax period wherein all the taxpayers were required to register has passed. And I'm sure all of you would have certainly registered your companies for corporate tax as per the date of issuance of your trade license. So, my friends, that was the inception of corporate tax, wherein we had to refer to our trade licenses we had to see the first issuance date of our trade license, and we had to register our companies for corporate tax. Once we registered, then the next thing came up was that when does my company have to file the corporate tax return? Now, to talk about the corporate tax return, in the corporate tax law by the FTA, they published two guides which were very important for the concept of corporate tax return filing in UAE. The first guide, my friends, was introduced in the month of July, which talked about how should I and how should my company determine or calculate the taxable income, which will be subject to tax. So this guide, my friends, had a lot of concepts. It talked about the calculations, it talked about the compositions, it talked about the expenses, the incomes, how will the expenses be allowed, what will be the expenses which will be disallowed. It also drew strong semblance from the Federal Decree Law 47, and it talked about how will Article 28 have an implication, how will Article 33 have an implication with respect to allowances as well as disallowances. After this guide, which was the determination of taxable income, was issued, after this, my friends, a very important guide came last year in the month of November, which was the corporate tax return guide. Now, since the concept of corporate tax return is now in the picture and now the return filing process have already started, with the first one being on 31st of December 2024. The next one is also upcoming. Many companies have their return filing due on 31st of March. And then, of course, the most vital one on 30th of September 2025 is around the corner. Now, how should the return be filed? What all components do we have to put in the return? What schedules will be a part of the return? And also what reliefs can be elected by the taxpayers in the return. All those concepts, my friends, are covered by the corporate tax return guide, which got published in the month of November 2024. We can move to the next slide, please. All right. Now, secondly, let's discuss, and I'm sure all of you in the audience are already aware of the fact that who has to file the corporate tax return. Now, my friends, what we've tried to do is we've tried to segregate the different legal entities or persons, I can say, in this slide. Now, if you're a resident person, you have to number one, register, number two, file your corporate tax return. If you're a natural person, and the revenue from your business activities in UAE exceeds 1 million, then you have to register and you have to file the corporate tax return. And thirdly, if let's say you're a non-resident, and by non-residents we mean that if you're a foreign company but you have a permanent establishment which is getting created in the state of UAE, or let's say you are a non-resident company and you're deriving any state sourced income in UAE, or if you have nexus in UAE. Now, let's spend a moment there and discuss a bit more about non residents because I'm sure this is a concept which is very dear to many of you. Why? Because I'm sure many of you in the audience will be having a foreign branch in UAE of a company which you have outside UAE. So, let's spend a moment here. Now, my friends, I'll take an example. Let's say you have a company outside UAE. Let's say you have a company in Germany, right? Now, by way of operations of this German entity, if it gets proven to the FTA that this German company or this German entity has a permanent establishment in UAE, then, my friends, this German company, number one, has to register itself for tax. Number two, it has to file the corporate tax return. Now, what do we mean by PE and how will it get created? Now, my friends, let's take an example of this German company itself. Let's say it is in Germany, but let's say there are few employees of this German entity which are often traveling to UAE on, let's say, a secondment or a deployment, right? They come to UAE for business activities and for their employment purposes. Now, my friends, we have to refer the double taxation avoidance agreements in these cases and see the residency clause between UAE as well as Germany. If these people are staying in UAE beyond a particular period which has been defined by the double taxation agreement between UAE and Germany, then it will be said that these people are creating a service PE in UAE. Yes, my friends, I said a service permanent establishment. And why a service permanent establishment? Because by virtue of their secondment or deployment or their occupation or the services they are rendering, they came to the state of UAE. They were staying here and they were working in UAE, generating income, but they belonged to the German entity. That gives rise to a service PE. Similarly, there can be situations wherein a fixed place PE can be created Let's say this German entity has a warehouse in UAE. The core business activities are being carried out from the warehouse. Similarly, there can be a situation wherein an agency B is created, right? This German entity may be acting as an agent on behalf of any other company in UAE. It may be negotiating contracts on behalf of that entity. It may be signing contracts on behalf of this entity. Even then, a permanent establishment is created. Secondly, in this case, my friends, there can be a situation wherein there is any trade happening between the German entity and the UAE entity. And when the German entity has the sale purchase transaction with the UAE entity, then the title of the goods gets transferred on the port of UAE, or there is any income which the German entity derives in UAE, it is getting booked in the bank accounts of UAE, then we say that the foreign company is deriving state sourced income from UAE. And what does that mean? It means that it is deriving a income which is sourced in UAE. Thirdly, there can be a situation wherein, let's say, this German entity has a commercial property in UAE and this German entity is deriving rent out of this commercial property. Then we say that the German entity has a nexus in UAE. Yes, my friends, so if either of these three situations also occurs, then yes, your non resident company, which is a foreign company, number one has to register for tax, and number two has to file the corporate tax return. We can move to the next slide, please. All right, interesting. That brings us to the first poll question of the day, my friends. And the question is, what is the deadline to file the corporate tax return? Your options are number one, 12 months from the end of the first tax period, and number two, 9 months from the end of the first tax period. You have 30 seconds to answer. Your time starts now. All right, everybody. Thank you so much for the overwhelming response. And I'm so glad because more than 93% of the people have answered the question correctly, saying that yes, 9 months from the end of the first tax period is the deadline to file the corporate tax return. Now, taking a cue from this, we'll discuss regarding the deadlines in our next slide. All right, my friends. So, as we just discussed, the deadline for filing the corporate tax return is 9 months from the end of the first tax period. Now, let's take the three examples which I was discussing previously as well, which are practical, and I'm sure many of you would be falling within these three deadlines which we've talked about in the slide. Now, my friends, if let's say your first tax period started the moment the corporate tax law came in UAE, let's say your company had chosen in the Memorandum of Association the tax period starting from 1st June 2023 to 30th June 2023. Then, in that situation, what happens, my friends? In that case, the deadline to file the corporate tax return will be 31st December 2024. Secondly, there can be a situation wherein your tax period is 1st July 2023 to 30th June 2024. In that situation, your deadline will be 31st March 2025. And thirdly, there can be a situation wherein your tax period is 1st January 2024 to 31st December 2024, which is very vital and which is applicable in case of most of the companies. In that case, your deadline shall be 30th September 2025. We can move to the next slide, please. All right. Now, my friends, let's talk about the fact that what happens when we file the corporate tax return. How are the corporate tax rates applicable on us? Now, my friends, let's take the example of two sectors. Now, as we know, entire UAE is divided into two kinds of entities. Few entities are into mainland, few entities are into free zone, right? And the rates of tax also differ depending on whether your company is in mainland or whether your company is in a free zone. Firstly, let's talk about the case wherein you have a mainland entity. Now, my friends, if you have a mainland entity, in that case, from your net profit, which is also referred to as the taxable income, up to 375,000, you're subject to 0% rate of tax. And for your net profit above 375,000, you're subject to 9% corporate tax. Moving forward now, if I talk about what happens in case you become a qualifying free zone person. Now let's spend a moment here. Let's say you have your company in a free zone. Now, my friends, as we know and as we've discussed in multiple webinars and seminars before this, if your company is a free zone, number one, we have to check which free zone are you into. Number two, we have to check what kind of an activity is your company doing. And that we have to check from, of course, our ministerial decision 265 read with cabinet decision 100. We will see what activity you are doing. Depending on that activity, we will determine whether that activity is qualifying or not and what is the source of revenue which you are deriving. Now, let me take an example, a very important and a very practically prevalent example of a distributor. Now, my friends, let's say you are a distributor and you have your company in a free zone. Now, if you're a distributor and if you have your company in free zone, then my friends, the concept of designated zone also comes into the picture. We have to see that if your company is situated in a designated zone. So, my friends, particularly for distributors, the Ministerial Decision 265 has said that if you're a distributor, if you're situated in a designated zone, then we have to see that what are your sources of revenue. For a distributor in a DZ, which is a designated zone, we have to see whatever transactions or trade you're having between a free zone to free zone. Now, if this free zone customer is a beneficial recipient in their own capacity, then in that case, my friends, this free zone to free zone revenue for you will become qualifying, it will become zero rated. Secondly, there can be a situation wherein you are a distributor in a designated zone and you're having your sale transactions with, let's say, companies in mainland, or you're having export sales, right? In that situation, we have to see and we have to take certificates or declarations from your customers in mainland as well as exports, which is overseas, to justify to the FTA that your customers are B2B. And B2B means that they are not the beneficial recipients, which means that they should be resellers, retailers, or distributors in their own capacity. In that situation, also, whatever revenue you get from these transactions with mainland or with these transactions with export, which is overseas, then even that is subject to zero rated. Now, for that, my friends, there is another condition in the ministerial decision which is mentioned, which talks about the fact that your goods should pass through the designated zone, which means that the goods should, number one, either be offloaded at a designated zone and then sent, or in case there is any high sea sales, which means if there are any third port shipments, in that case, the revenue should get billed in the books of the UAE entity, which should be in DZ, number one. Number two, the core activities of ensuring that the logistics are done properly, ensuring that the goods are passed to the DZ, all those activities. And by that, I mean the core income generating activities should be done in the designated free zone. Now, my friends, we have faced a situation also that there is a distributor in a free zone, but not in a designated free zone. For them, what happens? For them, there is an option which has been given by the law that you can open either another company in a designated zone, shift your trading operations or your main core income generating activities there, and then have your business from there to become zero rated, number one. Or number two, my friends, you can outsource your core income generating activity of distribution to, let's say, a warehouse service provider or to a logistic company in the designated zone and exercise adequate supervision when you outsource your core income generating activity. In that situation, also, the revenue which you get will be zero rated. But my friends, there can be a situation wherein, let's say, you are a free zone company, you have income which is your qualifying income. However, let's say you are doing an activity which is not covered in our ministerial decision 265. Then what happens, my friends? In case you're a free zone and you're doing any activity which is not covered by the ministerial decision 265, then in that case, whatever revenue you get from this activity, number one, it will be considered as non qualifying in nature. Number two, it has to be tested for de minimis. I'm sure all of you are aware about the de minimis condition also. It's one of the important conditions. I believe it is condition number three of Article 18, wherein we have to check that whatever income currently is belonging to any of our non qualifying activities, will that exceed the de minimis threshold? If, let's say, my friends, the de minimis condition fails, which means if your non qualifying income is more than the de minimis threshold, then in that case, if you're a free zone company, your entire operations, my friends, and yes, this is very important to note and be careful about. If you're a free zone person and if you fail the de minimis condition in the Article 18 test, then in that case, your entire revenue becomes subject to 9%. Yes, entire revenue becomes subject to 9%. And in that case, your company will not get the threshold benefit of 375,000 as well, which means on your company, the flat tax rate of 9% will be applicable. We can move to the next slide, please. All right, my friends. Now talking about the reliefs which we earlier discussed, which the companies are eligible to elect in the corporate tax return. One of the most pivotal and important reliefs which all of us have been discussing about since a long time is the small business relief. We will talk about this in greater detail. Let's move to the next slide, please. All right. So, my friends, before we talk about the concept of small business relief and before we talk about who is eligible for small business relief, let's take a moment and answer the second poll question of the day. The question is, are natural persons eligible for claiming small business relief? You have 30 seconds to answer. Your time starts now. All right, thank you everybody for answering that question. And I got a mixed response there, wherein around 70% of the people answered the question correctly, saying that yes, natural persons are eligible for claiming small business relief. Let's talk about this in our next slide. All right, my friends. Now, let's talk about the important concept of small business relief. Now, my friends, let's say if you are a company, okay, so let's divide this slide into two parts. First, let's talk about juridical persons, then we'll talk about natural persons. Now, let's say, my friends, you have a company, which means you have a legal entity. Now, in case you have a legal entity and your revenue or your turnover or whatever income you're getting from your business operations does not exceed 3 million dirhams in the Gregorian tax period, which means if you're following Jan to December, then your first tax period was Jan to December 2024. So, in that case, if the revenue of your legal entity during Jan to December does not exceed 3 million dirhams, then in that case, you are eligible to opt for small business relief in your corporate tax return. Point number one. Point number two is that, my friends, let's say if you're a mainland company, then yes, this threshold of 3 million is considered. If you're a mainland company and if your revenue does not exceed 3 million, then yes, you are eligible for claiming small business relief. Point number two. Point number three, let's say, what happens if you have a company in free zone? Now, my friends, the intention and the intent of the law is that no entity will be given two benefits, right? So let's say if you have an entity in free zone and if you are claiming the benefit of qualifying free zone person, which means that if you have your company in free zone and you want to become zero rated, right? Then in that case, the small business relief is not eligible for you to elect for. So let's say you're a qualifying free zone person and your revenue is not exceeding 3 million. Then in that case, do you stay as a qualifying free zone person or do you elect to claim small business relief? You will have only one option. So, my friends, if you want to go ahead with getting the qualifying free zone person benefit and your revenue does not exceed 3 million during Jan to December, then in that case, you cannot claim the small business relief. So, in order to claim the small business relief, you have to give up your qualifying free zone status. Only then can you claim the small business relief. Point number one. Point number two, now let's talk about the poll question which we were discussing about natural persons. So, my friends, if you're a natural person, which means what? Which means if you're an individual, if you're an establishment, if you're a sole establishment, if you're a sole proprietorship, right? In those situations, if you're a natural person, and your revenue exceeds 1 million dirhams during again the Gregorian period, which is Jan to December. Then, number one, in the eyes of the law, you will be categorized as a natural person. Number two, you have to register yourself for corporate tax. And for natural persons, the deadline for registration is 31st March 2025. So, my friends, if you're a natural person, as per your trade license, and if your income from business activities is exceeding 1 million dirhams during Jan to December, then number one, you have to register yourself for corporate tax. Now, my friends, once you register and your revenue exceeds 1 million dirhams, but let's say during Jan to December, it does not exceed 3 million dirhams. So, if it is more than 1 million, but if it is less than 3 million, then in that case, being a natural person, also you have the option of electing for small business relief in your tax return. Yes, my friend. So the option for getting a relief under the small business relief regime is available for natural persons as well. But the only thing you have to be careful about is that the revenue which you're generating should not be derived from any sources such as salaries. It should not be in the nature of wages. It should not be from any personal investment, which means it should not be any interest from any fixed deposit which is in your own name. And it should not be from any estate investment which is in your personal name. If you're getting any revenues from those sources, my friends, then those sources of revenue are exempt from tax if you are a natural person. So, just to summarize about the small business relief, my friends, the benefit of getting the eligibility and the benefit of claiming the small business relief, my friends, is available with the sunset clause. I'm sure all of you know about it. And yes, the sunset clause is 31st December 2026. So, my friends, this regime and this benefit is available to juridical persons as well as to natural persons only till 31st December 2026. The FTA is still silent with the fact that are they going to extend this threshold time limit beyond 31st of December 2026, or they're going to increase the small business relief threshold from 3 million to a higher amount, or are they going to reduce it from 3 million to a lower amount? That is still a gray area, and the FTA is yet to comment on it. We can move to the next slide, please. All right. So as we just discussed the implications while we were discussing the previous slide, we put the implications on this slide as well for you. If you're claiming small business relief, then you have to file a simplified corporate tax return. Number one. Number two, your filing compliance is reduced. And how is that so? Because I'm sure many of you would have already seen the format of the corporate tax return on the MRO tax portal, my friend. So the moment you select that you're electing for small business relief, the tabs next to that disappear. So your corporate tax return gets simplified, and you're not supposed to fill an elongated corporate tax return for filing corporate tax in case you're claiming small business relief. We can move to the next slide, please. All right, my friend. Now, in this section, what we'll be discussing is we'll be discussing about a very important and a very vital concept which revolves around free zone qualification in UAE. Let's discuss about the concept of free zones and why is it important while we are now approaching the first tax filing season. Let's discuss that in the next slides, please. We can move to the next slide. Yeah. All right. Perfect. Now, my friends, as we just discussed about the concept of free zones, so let's spend a moment here and discuss about how has the concept of free zones evolved in UAE. As you can see on this slide, we've put a time chart. So, my friends, let's date back and let's go retrospectively to discuss how the law got incepted. When did the concept of free zones come? Why was it important? And why so many decisions and guides and everything has come on free zones? So, my friends, as we discussed previously as well, the Ministry of Finance had first announced regarding the corporate tax law in January 2022. Now, my friends, in the same year during 2022, the corporate tax law was also published in the official gazette. And moving forward, as all of us know, the most pivotal date in UAE for corporate tax has been 1st June 2023. 1st June 2023 was the date when the corporate tax law got effective in UAE. Now, my friends, as soon as this corporate tax law got effective, a lot of questions arose in all of our minds that we have companies in mainland, we have companies in free zones, who gets what benefit, which activities are zero rated, which activities are subject to 9%. Everybody was confused about that. Now, to put an end to those confusions, the cabinet decisions and the ministerial decisions started getting published. Now, my friends, what happened was that before the month of October 2023, before that, and initially, the FTA had published Cabinet Decision number 55 of 2023, which talked about determination of qualifying income, and it had published Ministerial Decision number 139 of 2023. So, my friends, before the month of October 2023, going back and retrospectively looking at the law, two important decisions were published. One was Cabinet Decision number 55, second was Ministerial Decision number 139. Later during the year, the FTA wanted to number one, expand the list of activities which it wanted to cover as qualifying activities. Number two, it also wanted to encompass regarding the intellectual property. Number three, it also wanted to give a clarity to the real estate sector as well as to distributors. To give all these clarities, the FTA and the Ministry of Finance revoked Cabinet Decision number 55 and they published Cabinet Decision number 100. Similarly, they revoked Ministerial Decision number 139 and they published Ministerial Decision number 265 during the month of October 2023. Now, my friends, these decisions talked about the fact that what are the qualifying activities, what activities do we have to do to check our eligibility to becoming zero rated. They gave a lot of clarity around distributors, like we previously discussed, what happens between free zone to free zone, between free zone to free mainline, between free zone to export sales, what happens during offloading at designated zone and selling goods, and what happens for third port shipments. All those clarities were given by Ministerial Decision number 265. They also gave a lot of clarity and they said about intellectual property. So if you're generating any revenue from intellectual property also, that revenue also they have covered in the qualifying activity, and they've also given a formula to calculate the benefits which your company can get. Now, my friends, both these decisions were issued and everybody, including us as well as yourselves as taxpayers, all of us got a lot of clarity around the concepts of free zones. Now, to concise all of this and to put all these concepts around free zones together, the FTA published the Free Zone Guide during the month of May 2024. Now, my friends, this guide had concised and encompassed all the provisions revolving around free zones. It, talked collectively about Article 18 of the law. It talked about the various FAQs which have been published. It correlated and talked about the fact that how are we linking Article 18 with the Cabinet Decision number 100, along with the Ministerial Decision number 265, and with the rest of the FAQs. It also talked about the fact that if your company wants to claim the qualifying free zone status in your corporate tax return, then in that case, you also have to comply with the transfer pricing documentation conditions. So all these concepts were linked together and they were summarized in the Free Zone Guide, which got published in the month of May 2024. We can move to the next slide, please. All right, now, my friend, that brings us to the third poll question of the day. And the question is, if a company fails to meet any of the conditions required for becoming a qualifying free zone person, for how many years will it lose its status as a QFZP? The first option is 5 subsequent tax periods, second, 4 subsequent tax periods, and the third is 10 subsequent tax periods. You have 30 seconds to answer. Your time starts now. All right, thank you everybody for the response. And again, we got a mixed response wherein around 50% of the people answered the question correctly that if your company fails to meet any of the conditions under Article 18, then you lose the qualifying free zone status for 4 subsequent tax periods. Yes, my friends, the correct answer is 4 subsequent tax periods. Let's discuss about these 6 conditions of the QMZP in our next slide, please. All right, my friends. So, as we're aware, what does Article 18 talk about? Article 18, my friends, is one of the most widely discussed articles around all the business sectors in all the seminars in UAE. And this article talks about the 6 most important conditions which a free zone entity has to meet. Only then will that free zone entity be subject to zero rated tax. So, my friends, the first condition is maintenance of adequate substance. Now, as all of you know, when we talk about adequate substance, we talk about having adequate number of full-time employees, number one. Number two, having adequate assets, which by assets I mean having the title deeds of the assets of the intangible assets as well as of the tangible assets in the name of the company in free zone. Number three, it talks about the fact that we must have um, robust and substantial operating expenses getting incurred in the books of our entity, and this entity should be in free zone. If all these 3 conditions get satisfied, my friends, then we say that the first condition of adequacy of substance in UAE is getting substantiated and it is getting fulfilled by the company. Now, I'm sure many of you will be thinking, and there will be many people out there in the audience who, let's say, be software developers, or who, let's say, will be having businesses which are more like a one-man show. Then, how do they meet the adequacy substance condition, right? Then, my friends, let me tell you an intelligent insight there. So, the insight is that the concept of adequacy is subjective. Yes, my friends, it is subjective. So there can be a situation wherein, let's say, you're a software developer and you have a flexi desk in free zone. You're taking care of your activities from that flexi desk. And since you're one individual in the capacity as a software developer, you are having your operations and you're running your business from the free zone, then your question will be, am I meeting the adequacy of substance condition? The answer is yes. In these situations, my friends, you have to build a strong case. You have to justify to the FTA that why this one single person having a flexi desk in UAE is even satisfying the condition of adequacy of substance. You have to prove to the FTA that this one individual is enough and justifiable to run the operations from the free zone. So basically, just to say again, the condition of adequacy, my friends, it is subjective. It depends on your nature of business, number two. It depends on your trade license, number two, number three. And it depends on how you are maintaining the substance in the free zone. This was the first condition. The second condition, my friends, is the concept of deriving qualifying income. So, my friends, Article 18 says that if you're deriving qualifying income specified under the Cabinet Decision number 100, read with Ministerial Decision number 265, then we say that you're meeting the second condition of becoming a qualifying free zone person. The third condition, my friends, is that you should not elect to be subject to corporate tax. So, when does this situation happen? So, let me give you a practical example there. There can be a situation wherein you have your company in free zone, but because you do not want to claim the free zone benefit because of the various costs which are involved, let's say in maintaining adequacy of substance, or let's say you want to change any of your activities to claim the free zone benefit. If let's say you do a cost benefit analysis at your company's end and you feel that instead of claiming the free zone benefit, even though if you're in free zone, but it is better that you continue your operations the way you're continuing and you're okay with paying the 9% tax, which is subject to a mainland, then in that case, in your corporate tax return, you have to elect that you want to be subject to corporate tax. If, my friends, being a free zone entity, if you make that election, then you lose the qualifying free zone person benefit. So I'll repeat again. First condition was adequacy. Second condition was qualifying income. Third condition, my friends, is that you should not elect to be subject to tax, because the moment in your corporate tax return you elect to be subject to tax, then in those situations you lose the qualifying free zone person benefit. The fourth condition, my friends, is that, and it is a very important condition, is that if you want to claim the qualifying free zone person benefit, then you have to comply with the transfer pricing regulations, which means that you have to do the benchmarking. You have to file your transfer pricing disclosure form, and you have to maintain adequate transfer pricing documentation. Only in those situations, my friends, you will continue to get the qualifying free zone person benefits. The fifth condition, and a very important one again, is maintaining audited financial statements. So, my friends, if you have your company in free zone and if you want to claim the qualifying free zone person benefit, then you have to ensure that you maintain audited financial statements. And the last condition is satisfying the de minimis. Yes, and by that, of course, we mean that your income from any non qualifying activity should not exceed 5% of your total revenue or 5 million, whichever is more. So that condition you have to satisfy. Only then we say that if you satisfy all these six conditions, then we say that you are eligible for claiming the qualifying free zone person benefit. We can move to the next slide, please. All right, my friends. Now, in the coming forward slides, what we will discuss is about the transfer pricing documentation. What impact does it have on the corporate tax return? What are the mandatory transfer pricing documentations we are required to maintain? What are the optional ones? What is the meticulous documentation which we have to maintain to justify the arm's length price to the FTA? So let's go to the next slide and discuss. All right, my friends. So first, now when we talk about transfer pricing, let's discuss why transfer pricing came in UAE, how it came in UAE, and on who is it applicable. So, my friends, the FTA has categorically mentioned in the Federal Decree 47 that transfer pricing provisions in UAE are based on and they derive their genesis from the OECD transfer pricing guidelines, which were published in 2022. So, my friends, the transfer pricing provisions in UAE are completely aligned with what the multinational guidelines, which has been published by the OECD, talks about. So, my friends, now, what was the need of bringing about these transfer pricing provisions in UAE? Now, as we are aware, and long back, if again I focus on what the OECD says, in many situations, what was happening was that the base of corporate tax was getting shifted, number one. Number two, the taxes were getting evaded. Now, my friends, to put an end to base erosion and profit shifting, the OECD had introduced the concept of transfer pricing. And by that, what we mean is, I'll give an example. Let's say you have a parent company in US, and let's say the company in US is subject to 40% tax rate. Now, for this company in US, let's say you have a subsidiary in Cayman Islands. Now, with Cayman Islands, I'm sure all of you know that it's a tax haven. So let's say there is a parent in US and there is a subsidiary in Cayman Islands. Now let's say, my friends, to avoid paying excess taxes in US, let's say this US based entity is transferring its surplus profits or surplus funds to Cayman Islands. Now what is happening in this situation is that the base of corporate tax in US is getting eroded and the excess profits are getting shifted to evade taxes. So, to put an end to this, the OECD brought about transfer pricing provisions, and it said that if there is any transaction happening between two related parties, it can be domestic related parties or it can be cross border related parties. Those transactions have to be done at arm's length price, which means that they have to be done at fair market value, which again means that every transaction should have a commensurate benefit. And this commensurate benefit is to be reported to the tax authority of your particular country. Now, drawing semblance from this and placing reliance on what the OECD principle said, the UAE corporate tax law also believes in the same. And it says that whatever transactions you're having with your related parties, or in this case, UAE has also covered an important concept of connected persons. The reason for that is that UAE is one country where family businesses are very, very common. So, my friends, practically to address both these challenges, the FTA has said that if you're having transactions with your related parties or if you're making payments of salaries, remunerations, bonuses, other perquisites and benefits to your connected person, then in those situations, these transactions have to be benchmarked, number one. Number two, they have to be reported in the transfer pricing disclosure form. and this has to be submitted to the FTA by uploading on the MRO tax portal. So, my friends, again in UAE, just to summarize, the transfer pricing guidelines are aligned with OECD. Number one, transfer pricing provisions have been laid by Article 34, 35, 36, which talks about arm's length price, related party transactions, as well as connected person transactions. And in UAE, cross border transactions as well as domestic transactions fall within the purview of transfer pricing. And fourth, but not the least, these provisions are applicable not only on mainland companies but also on free zone companies. We can move to the next slide, please. All right, now that brings us to the fourth poll question of the day. And the question is, are all companies required to meet transfer pricing documentation compliance of a local file and a master file in UAE? You have 30 seconds to answer. Your time starts now. Very well. Thank you, everybody. And more than 50% of the people have answered the question correctly, saying that not all companies are required to meet the documentation compliance requirements of master file and local file. Yes, my friends, the concept of master file and local file is optional and it is not mandatory. Let's discuss that in the next slides. All right, my friends. So now, when we talk about transfer pricing documentation, let's break it up into two aspects. One is the mandatory documentation requirement, and second is the optional documentation requirement. So, my friends, when I talk about the mandatory one, in case you have a company and irrespective of the turnover, irrespective of any other conditions, if you have a company and if you're having any related party transactions within UAE or outside UAE with any of your domestic related parties or your cross border related parties, you have to disclose that in the transfer pricing disclosure form. Also, in the transfer pricing disclosure form, my friends, you have to talk about the fact that whatever payments you are making as salaries or remunerations to your shareholders, owners, directors, or any other officers who are the heads and brains of the company, all those payments have to be done at arm's length and all those payments have to be reported in the transfer pricing disclosure form. So, my friends, again, to summarize, irrespective of the turnover and irrespective of any other condition, whether you're in mainland or whether you're in free zone, if you're having related party transactions, one, if you're having connected person transactions, then in that situation, you have to file the transfer pricing disclosure form, my friends. And this form has to be filed along with the corporate tax return. It has to be uploaded on the MRO tax portal during September 2025. Now, my friends, to file the transfer pricing disclosure form and to fill the details in the transfer pricing disclosure form, what is that your company has to do? Number one, my friends, you have to identify the related party transactions. Number two, you have to identify the connected person transactions. Number three, for all these related party transactions, you must have sufficient and adequate intercompany agreements which talk about the terms between both the entities, which talk about the remuneration model decided between both the two entities, which talks about what service or what activity one entity is doing for the other. It talks about the tenure of the agreement or the contract, so on and so forth. So basically, to file the transfer pricing disclosure form, you must maintain all your intercompany agreements between related parties. You must have all the invoices, bills, debit notes, credit notes. You must make a transfer pricing policy at your company level wherein you talk about what are your transactions, how you're identifying them. One entity is becoming a related party as per which article? Let's say as per Article 35(2)(a), Article 35(2)(b), pursuant to which article is one entity becoming a related party. Number three, you have to talk about the fact that how is one particular individual being considered as your connected person under which clause of Article 36 for control? Is it Article 36(1)? Is it Article 36(2)? Which clause of Article 36 are you referring to determine that one individual who is a key managerial personnel is being considered as your connected person? And in this transfer pricing policy, you also have to mention that what method are you using to benchmark these transactions. Number three, you also have to mention about the arm's length range which you're deriving by performing the detailed benchmarking analysis. And my friends, let me reiterate and tell you one very important thing there, that transfer pricing benchmarking analysis is mandatory not only for related party transactions but also for connected person transactions. You must know the arm's length range under both the situations, and only then the arm's length price has to be disclosed in the disclosure form. So all these requirements are mandatory irrespective of your company's turnover, and transfer pricing disclosure form, my friends, is mandatory to be filed with the FDA. We can move to the next slide, please. Now, what is optional when we talk about transfer pricing documentation? So, my friends, both the concepts of local file and master file are optional in case at an entity level, your entity in UAE crosses 200 million dirhams, or at a group level, the group crosses 3.15 billion dirhams. Then, yes, you have to maintain local file at an entity level and master file at a group level. Now, let's spend a moment there and discuss what is the difference between local file and master file. So, my friends, local file is nothing but a transfer pricing documentation at a local level, wherein you'll talk about number one, your local entity. Number two, you'll talk about the industry to which this entity belongs. Number three, you'll talk about the FAR analysis, wherein you will conduct a detailed functional asset and risk interview with the senior management people of the company to see that what are the functions or activity which the company is doing, what are the assets which it is employing, be it tangible assets or intangible assets? And number three, what are the risks which the company is undertaking? These sections form a vital part of your local file. And these sections, how are we discussing about these sections and how do we know that these sections have to be there? Again, going back historically, like the FTA has said, that the transfer pricing regulations in UAE are completely aligned with OECD. And my friends, the OECD has categorically talked about what sections need to be covered in your local file, what sections need to be covered in your master file. That is why we're talking about all these sections here. So, yes, again, to summarize, in the local file, you'll talk about your industry, you'll give the FAR analysis, and of course, very important, you'll give the economic analysis, which will be the benchmarking of your related party transactions as well as connected person transactions. And at the end, you'll talk about what is the financial position of your company. What is the net profit margin which your company is earning? What is the gross profit margin which your company is earning? All these aspects, my friends, will get incorporated in the local file. And yes, it is optional only if your UAE entity crosses 200 million dirhams or the M&E group of which you're a part with the parent entity being in UAE, if that M&E group crosses 3.15 billion dirhams. We can move to the next slide, please. All right. Now, secondly, let's talk about the second optional documentation requirements, my friends, and which is the master file. So, what is a master file? As we've put on the slide, so my friends, master file is a global blueprint of your group as a whole. It talks about how is your entity a part of and how is it placed in the entire M&E group. It talks about the activities, functions, intangibles, value drivers, and the financial activities as well as tax positions belonging to the other entities of the M&E group. Basically, to disclose about all the entities' compliances and to disclose about the activities, value drivers, profit drivers, tax positions of all the entities of the M&E group. All those aspects, my friends, have to be covered in the master file. And let me tell you there, master file has to be filed again if at a local level your UAE entity crosses 200 million dirhams or at a group level the M&E group's turnover crosses 3.15 billion dirhams. Then your entity has to maintain local file at local level and master file at a group level. We can move to the next slide, please. All right, now the third compliance and transfer pricing, my friends, which is a little bit of a confusion as well, is that what happens if my company is an SME? Yes. What happens in situations if my company is claiming the SBR relief? So, my friends, now there is still an ambiguity in the law, and that we've just tried to highlight on this slide. Now, my friends, let's say your company is in UAE, number one. Number two, if the turnover or the revenue of your company is not exceeding 3 million dirhams, then what happens? Then, my friends, you are not obliged to file the transfer pricing disclosure form. Yes, this has been categorically mentioned by the law that if your revenue does not exceed 3 million dirhams in the tax period, then you don't have to file your transfer pricing disclosure form. But still, the law has mentioned that there can be a situation wherein tomorrow, during the FTA audit, the FTA comes to you, they send a notice, and they say that you have to substantiate your arm's length price of your related party transactions or your connected person transactions to the FTA. So, my friends, just to be cautious and be sure, number one, if you're an SME, which means if your revenue is not exceeding 3 million dirhams, then you don't have to file transfer pricing disclosure form, but it is highly advisable. And just to exercise abundant caution, it is advisable that you still do transfer pricing benchmarking for your related parties as well as for your connected persons because the FTA during the FTA audits can still come and ask about how are you having the transactions with related parties or connected persons at arm's length. So that was the concept about SMEs. We can move to the next slide, please. All right, my friends. Now, in this section of our presentation today, we'll talk about the issues and concerns and the gray areas which still exist in the law. We can move to the next slide, please. All right, interesting. That brings us to the fifth poll question of the day, my friends. And the question is, should the transactions between related parties be in compliance with ALP? You have 30 seconds to answer. Your time starts now. All right, great. Thank you, everybody, for the response. And more than 95% of the people have answered the question correctly, saying that yes, transactions between related parties should be in compliance with ALP, which means that transactions with related parties should be at fair market value. We can move to the next slide, please. All right. Now, let's talk about what issues and concerns and what to expect in the transfer pricing arena with the FTA. Now, my friends, what are the issues which we think can be cherry picked by the FTA during the FTA audits? The first issue is that there is a strong and stringent requirement for the related party transactions to be at arm's length. That's why, my friends, we are advising all the companies to ensure that whatever transactions you are having with your related parties should be at fair market value. You must conduct benchmarking for transactions to number one, disclose the arm's length price in the disclosure form. Number two, prove to the FTA whenever they request you for documents. Secondly, my friends, another issue which can crop up is that the FTA may cherry pick and question about the related party status. As we know, my friends, the concept of related parties in UAE is vast. It talks about the fact that there should be 50% ownership or control, there should be 50% shareholding, 50% stake in profits, 50% stake in the assets, right? And there is also a concept of kinship or affiliation, which goes up to fourth degree of kinship or affiliation. So, my friends, we are advising all of you to ensure that you have a look at your shareholding structures, you have a look at the structure of your company, you have a look at how everybody, the individuals as well as the companies in your entire group structure are placed to ensure that you substantiate and you justify which entities be considered as your related party, number one. Who are the individuals who are be considered as your connected persons, number two. So all these concepts, my friends, are very important. That's why it's advisable to be very careful about the kinship status in your shareholding structure as well as in the structure of your company. We can move to the next slide, please. All right. So now, my friends, in this slide, we've talked about the second and the most vital issue and concern which can arise again in the arena of transfer pricing is that selection of the most appropriate method. Now, as you are aware, and all of us have been talking about the fact that the related party transactions have to be benchmarked, the arm's length price has to be disclosed in the transfer pricing disclosure form. But the question in many of your minds which is arising is that how do I select the most appropriate method for benchmarking my related party transaction? So, my friends, again, going to the transfer pricing guide, which has been published by the FTA, the guide says that we in UAE are following what the OECD has said. The guide has categorically said that we will have 5 plus 1 most appropriate methods, which again have been derived by the OECD. The methods for determining the arm's length price, again, we have listed on this slide, my friends. It is either CUP, which is comparable and controlled price method, or it should be RPM, CPM, TNMM, TSM, or other method. So, my friends, either of these methods have to be selected. Now, the question in many of your minds will be, how do I select one of these methods? How do I know which method I have to select for benchmarking a particular transaction? So, to solve that doubt, my friends, let me give you an insight there. So, what the OECD has said is that the first most preferred method will always be CUP. CUP, my friends, ensures 100% comparability with uncontrolled transactions. Now, what does that mean? That means an apple to apple comparison. So, my friends, let's take an example there. Now, let's say again we take the example of a parent in US and a subsidiary in UAE. Now, let's say, my friends, this parent in US has an intangible property. Let's say it has IP which it has developed, right? And the UAE entity is using the help of this IP to manufacture, let's say, some API formulation or some medicine in UAE. Now, whatever right to use this UAE entity is exercising by using the intellectual property of the US entity and manufacturing the API formulations or drugs in UAE. Because of this and because of using the intellectual property, the UAE entity will pay, let's say, a royalty to the US entity, or it will pay any trademark fee, any brand name fee, any patent fee. Now, my friends, whenever you're making such intangible payments, mostly across the globe, what happens is that CUP method is used for benchmarking these transactions. So you have to go to transfer pricing databases such as OneSource, KT Royalty Stat, right, Orbis, and you have to find similar royalty agreements, similar trademark agreements, similar patent agreements, and see that in similar situations, how are third parties globally remunerating their related party, and what is the range of this royalty which is getting paid? What is the range of this patent fee, trademark fee, which is getting paid to the parent entity? So, in these situations, mostly CUP is used. Now, when I talk about RPM, which is resale price method. So, my friends, resale price method is mostly used in case of distributors wherein the gross profit margins are tested. But there is a practical challenge there that, my friends, the gross profit margins, number one, are not widely available in the database. Number two, the gross profit margins may not be the perfect universal representative of a company. Why? Because the gross profit margins do not take into account the below the line items of the P&L. Gross profit margins are restricted to the trading account, right? And they do not take into factor that how are the indirect expenses having an impact on the profit margins of the company. That is why in some situations RPM is used, but in most situations, even for traders, instead of RPM, we use TNMM. Third is cost plus method, which is generally used in case of manufacturers. But again, there is a challenge there that many a times what happens in that direct expenses are not the true representative of the company as a whole. Again, because they do not take into account the below the line items. That is why even for manufacturers and service providers, ultimately we end up using TNMM. And fourthly, my friends, let's talk about profit split method. Profit split method again has two aspects: contributory approach and residuary approach. If two entities are involved and both of them are have intangibles, their operations are intrinsically and closely linked, and they're developing something of a similar nature. In those situations, my friends, profit split method is used, wherein depending on what value each company is adding to the related party transaction, the profits are attributed to them. So, my friends, these are the four methods. And if nothing works, then yes, we come to the net profit margin method, which is TNMM. It is the method of last resort and it is widely used across the globe, and it is also widely accepted by most of the tax authorities globally. And there can be situations wherein, let's say, you are a real estate company and you rely on valuation reports, RERA reports. Then, how do you do the benchmarking? In those situations, my friends, you use the other method to justify your arm's length price. So, this was about the selection of method, and this is how you have to factor into different factors. And again, it is subjective. And on the basis of that, you have to select the most appropriate method for benchmarking your transaction. We can move to the next slide, please. All right, now let's talk about another ray of hope, I can say, in the transfer pricing arena in UAE, which is the safe harbor rules. Now, my friends, as you are aware, globally, many countries have the concept of safe harbor rules. And what these rules talk about is that the safe harbor regime, my friends, covers different activities together. It covers different profitability margins as arm's length range. And if your company is performing any of those activities, then you are not required to do a separate benchmarking to justify your arm's length price. You can simply say that the profit margin at which you are functioning falls within the safe harbor rule activities. This is the activity as per harbor rules. This is the activity which my company is doing. That is why this is the profit margin which I am earning. And this margin has again been defined by the safe harbor rule. Now, the ray of hope from the FTA is that they have briefly talked about the safe harbor rules in the transfer pricing guide, and they have said that for any low value added services being performed, the FTA will accept a cost plus 5% markup as a safe harbor. That is what they have talked about in the transfer pricing guide. And they have said that if your activities are, let's say, admin in nature, HR in nature, payroll processing, basically low value added or incidental to the main business activity, not belonging to the core business activity of a company, in those situations, you can use a cost plus 5% markup. We can move to the next slide, please. All right, my friends, now to summarize today's session, we have put all the takeaways together in the slide. Today, we talked about corporate tax return filing deadlines. We talked about the reliefs such as small business relief. We talked about qualifying free zone persons. And last but not the least, and very important, we talked about transfer pricing documentation. So now with that, we come to the end of the session. We can go forward and have the Q&A, and I would like my colleague Hajra to take over and commence the Q&A session. Thank you.
Thank you so much, Miss Aditi, for such an engaging session, insightful session. I can see already a lot of questions are coming in. So we should actually move to the live Q&A section segment now. And before we proceed, I would like our audience to, rate our webinar today. And I want to tell you all that we have our Google reviews. QR code in front of you on the screens as well. Please scan it, and it will help us to get more effective in our upcoming webinars. And we would be greatly appreciative of that. So now I would hand over the stage to Miss Tanya and Miss Aditi to answer the questions from our lovely audience. And over to you, Tanya and Aditi.
Thank you, Hajra, and thank you, Aditi, for such an engaging session. So we move forward to the Q&A session. So the first question that we have is from Miss Anisha, and the question is, what are the rules for the transfer pricing documentation? That is, what is the mandatory documents and what is the optional documents?
Thank you, Anisha, for that question. So, again, just to summarize what we discussed in the presentation as well, the mandatory transfer pricing documentation, Anisha, is the transfer pricing disclosure form, irrespective of the turnover of the company, irrespective of the activity it is doing. If you are a company in UAE, if you have a trade license in UAE, and if you're having any related party transactions, which can be domestic or it can be cross border, as well as if you're making payments to your connected persons, which means if you're making payments to your owners, directors, shareholders, or senior officers who are exercising significant control over the business, then in that case, you have to file your transfer pricing disclosure form. You have to report these transactions there, Anisha, and you have to disclose these at arm's length price in the transfer pricing disclosure form. So that is mandatory. However, at the same time, in case you are an entity in UAE and at a local level, Anisha, you cross 200 million dirhams, or at a group level, your M&E group with the parent in UAE, if at a consolidated level you cross 3.15 billion dirhams, then in that case you have to make local file for the entity and master file for the group as a whole. So transfer pricing disclosure form is mandatory, local file and master file is optional. What do you think, Tanya? What do you have to add there?
As rightly said, Aditi, there are three kinds of documents for transfer pricing, out of which one of them is a mandatory document that every company who has been registered for corporate tax and they are having transactions with their related parties and connected persons, they will have to file the disclosure form. So the details of such transactions will have to be furnished to the FTA in this particular form. While on the other hand, the local file and master file is two kinds of documents which will have to be maintained only if a particular revenue threshold is being exceeded. Now, moving on to the next question, we have it from Desert River, and the question is chart of accounts, that is, audited financial statements required for CT filing?
All right, Desert River, thank you for that question. So, when I talk about the chart of accounts or the audited books of accounts, so see, as per law, what they have said is if you're a mainland company and if your revenue exceeds 50 million dirham, in that case, Desert River, you have to get your books of accounts audited, number one. But number two, if you're a free zone company and you want to claim the qualifying free zone person benefit, in those situations, irrespective of your revenue, you have to get your books audited. Now, that is what is mentioned by law. But let me tell you one fact that Desert River is that irrespective of your turnover, irrespective of whether you're in mainland or whether you're in free zone, now what we are advising all the clients is that since corporate tax has come, number one, since corporate tax return filing is mandatory, number two, since transfer pricing disclosure form filing of that is mandatory, number three, to substantiate all the figures which you're putting in your return, in your disclosure forms, it is always better and advisable to have your books of accounts audited. Why is that? Because practically, as soon as you upload your corporate tax return as well as your disclosure form, and once the FTA audit starts, the first document the FTA is likely to request from your side is the set of audited books of accounts. So at that time, it will become impossible for you to get your books of accounts audited for 2024 because 2024 would have already passed. That's why it's better that right now, since many companies are closing their books of accounts for 2024, it is still advisable that at least in this quarter, you complete your audit and you get your books audited. What do you think, Tanya, basis practical experience?
Rightly said, Aditi, we have been facing this issue with most of our clients. So most of our clients have this particular doubt. Is it mandatory to get their books audited? Now, being the first tax period and being the first time that all the companies are going to file their return, out of abundant caution, it is always advisable to get their books audited because we have no idea to what extent the FTA audits can be undertaken being the first tax period. So out of caution, it's always advisable that the company maintains audited financial statements for the CT filing. Now, moving on to the next question, we have it from Mr. Jenny, and the question is who all will be considered as related parties? For example, if a company is having headquarters in Dubai and subsidiaries outside UAE, will they be also treated as the related parties?
All right, Jenny, thank you for that question. So when we talk about who will be considered about for as related parties in your current situation is as Jenny C. As you rightly said, the headquarter is in Dubai, right? And you have your subsidiaries located outside UAE. Now, in this case, Jenny, you have to see that what is the relationship with which this UAE entity has with the subsidiaries in outside UAE, right? You have to see that whether there is common control, whether there is common ownership, whether there is more than 50% shareholding, more than 50% voting power, more than 50% share in profits, more than 50% stake in the title of assets of those entities. If either of these conditions are getting satisfied, number one, or number two, if either of these entities is exercising significant control or influence over the decision making of the other entity, then these two entities, Jenny, will be considered as related parties, and the transactions happening between these entities have to be reported in the transfer pricing disclosure form in UAE, number one. Number two, the transfer pricing benchmarking has to be done for these related party transactions. What do you think, Tanya?
As rightly said, Aditi, so as per Article 35, related parties constitute up to fourth degree of kinship, as well as companies who are having shareholding of more than 50%, whether it's in the shares, the voting rights, everything, they all will be classified as related parties. And similarly, in this case, we will have to assess what is the relationship between the headquarter and subsidiary, what is the shareholding, based on which we'll be able to tell whether it is a related party or not. Now, due to the time restrictions, we have come to an end to the webinar, and I hand it over to Hajra to conclude the webinar.
Thank you so much, Aditi and Tanya, for delivering us this engaging and informative session. I can still see people are raising their hands, and we are still getting questions in. So, thank you so much, everyone in the audience, to join us today and contributing to this experience. And your participation and presence has truly, truly made this session very impactful and valuable. And there are still so many questions coming in, so keep pouring your questions to us, and our team will reach out to you, and will try to assist you as much as possible, and we look forward to connecting with you in our future webinars. So until then, if you have any queries regarding VAT, corporate tax, excise tax, financial audit, the details are given on the screen. Our contact numbers, our email addresses are there as well. You can reach out to us, and we will be more than happy to assist you. And until next time, thank you again, and we'll see you again in our upcoming webinar. Have a great day ahead. Bye.